Per usual, living on the channel is for educational purposes only and is not intended as financial advice. It is Monday once again. Let's take a look at some macro data points. I'm going to start with the usual institutional crypto flows. The 7th week of inflows. Thanks again to James at CoinShares for putting these reports together. And we're seeing what we want to see. Arguably, the market is pricing in ETF approvals. It is getting ready. Things are getting serious. I don't think you'd see inflows like this otherwise. I don't think you can point to any other event around the world. You can't even say uncertainty anywhere, whether it be geopolitical or fiscal or whatever, right? I don't think it's any of that. I think this is all specifically ETF related at the moment. And it's pretty much across all products in Bitcoin land. Some inflows into ETH and Solana, outflows into short Bitcoin, tiny inflows into Cardano of all things. And it really is global. Germany, Switzerland, US, Canada, everybody's joining the party here. Sentiment is positive, and that's extremely good news. That's what we want to see. That's what we expect to see. I had some questions about ETF deadlines. James Seifert of Bloomberg is the best place to go for that. I'll put a link to all this in the description of the video. But we're coming up on some deadlines. There's some windows between comment periods and the first deadline and the second deadline, and then we've got the government shutdown stuff potentially to deal with, and that's going to push the SEC into some sort of hurried decision-making process potentially. Are they going to approve all these at once? Probably. Are they going to approve them before the end of the year? Maybe. Do they have to approve them all at once? No. They can approve them one at a time and then give start dates into, February or whatever. So still a lot of unknown unknowns or known unknowns, but the clock is ticking and we get closer to a very likely ETF and we get closer to having every day. So I would allocate accordingly. Personally, that's what I'm doing. Another look at GBTC and ETH. I'm getting more questions about Grayscale stuff too. And I just don't think anything else here is worth touching other than maybe GDLC, which is the basket product. They don't have that listed here. I believe that has a 30% discount. That's mostly Bitcoin and ETH. But all this other stuff either has a premium, it's super tiny. And I just, it's interesting. It'll get a headline that this has, Solana has an 800% premium, but I don't personally think it's worth touching any of that. If you really absolutely want exposure, open a Kraken account. It takes 30 minutes, okay? And I realize certain accounts can't touch certain crypto stuff. I get it, okay? But please, just, have some common sense here and avoid stuff with a 900% premium. As far as a rotation trade or a trade idea, ETH has a slightly larger premium than GBTC. From a TA range perspective, we may be seeing evidence of inverted head and shoulders. A higher price here would point to a higher ETH price relative to GBTC. The monkey wrench here, of course, is if we get an ETF approval on the spot side for Bitcoin, we'll probably see this range just get blown out temporarily to the downside. I don't expect ETH to outperform on that day. So there are plenty of interesting ways to play this that aren't sitting in, Filecoin Trust at 1,000% premium. Okay. So just keep that in mind. Getting questions about mining stonks as well. My general view on mining stonks is it is a dog-eat-dog survival of the fittest world out there. You've got miners holding coin. You've got miners mostly in the US, regulatory risk. You've got hash rate going to infinity. You've got halving coming up. You've got electricity costs, energy costs to deal with. In general, I think mining is an extremely tough business. So if you want to go deeper on any of this stuff, the Miner Mag, again, I'll leave this in the description. This has the best repository for all of the important information that you'd want to see on the business side of things. I think the most important thing is probably how much BTC are these companies holding, just because the stocks may trade relative to BTC's strength according to the amount of BTC these companies are holding. I believe down here somewhere they've got post-halving break even somewhere, so go digging in the data. I'm the last person to ask about any of that stuff. I would much rather just look at the price chart and look at the technicals. Mara's the biggest miner by market cap. It's below the daily cloud. It's got an ugly head and shoulders potential pattern here. Higher highs would point to an edge through the daily to maybe 14. We will see if miners have higher beta relative to Bitcoin after halving or relative to price appreciation. That's typically what we've seen with gold miners. It's an analogy that many people have made. I think it's just too early. There's not enough trading history here. And in the moment, I don't have a lot of faith that these are going to be bullish. In the near term, this is WGMI. This is the Valkyrie ETF basket of miners. This also is turning down at the Kijun on the daily, below the daily cloud. Yes, there's potential for an edge to edge here, but I don't think you can will this into being in the moment. This does look bearish, and there's really no other way to slice that. Now, if this starts to get into the daily cloud, then sure, I like that as a trade. Maybe 975 to 14, something like that. But I would much rather personally hold Bitcoin relative to the miners. That may change. That may end up being a poor decision, but I just don't see it in the moment. Something else to consider on the Bitcoin side, as we sort of creep our way up these market cap tables relative to the M1 money stock of countries, right? We are in this conversation now, increasingly. And one way to read this is, look, we're still relatively small based on market cap relative to where we could be. And another way to compare that is, let's look at silver, let's look at gold, let's look at the Mag 7, right? Let's look at what anything you want to stack us up against. Compare us to risk, tech stock, compare us to store of value in gold, compare us to real estate. You know, the potential for the B here to turn into a T is still quite high and likely, most would argue. And again, if you're trying to sell this stuff, if you're a BlackRock ETF seller, you know, I think that's a very easy argument to make. Also helping your case is Bitcoin outperformance relative to the S&P and relative to the NASDAQ. Point again, stack us up to anything this year, TLT, whatever. Yes, we do have violent drawdowns from time to time, about every 4 years. Must be sized appropriately in a portfolio, is what they will argue. But the upside potential is getting too much to ignore on the legacy side as we continue to mature. All right, on to some more pure macro legacy stuff. Like I said yesterday, a bunch of Fed speakers. CPI is the big one this week. Tomorrow at 8:30 Eastern. And then we've got PPI on Wednesday. Current expectations for the Fed in a month from now, which is a decent chunk of time, is still no hike. If CPI continues to come down, which it likely will based on the numbers, this will probably jump to 90-95%. And we can look at Truflation. We can look at Fed Nowcast. Truflation has creeped up closer to 3 rather than 2. And that just may be the new world we live in, between 2 and 3% on Truflation, which would be 2.5 to 3.5 potentially on CPI. The last CPI was 3.7, and the current estimate by the Fed is 3.28 for October, and they have it even coming down to 3.16 in November. So we may see an instance where CPI is catching up to Truflation, as Truflation may be slowly rising into Q1. You know, if we start to see Truflation ticking up to 3.5 to 4, while CPI is ticking down, you know, below 3.5, that would definitely be an interesting lead lag signal. And how we might see that is because of how the housing data is baked into CPI. Everybody's talked about this, but why the Fed uses what they use is silly. They could definitely use more real-time data, even slightly less delayed data for a better decision-making process. But the housing component of CPI is still making its way through that equation. So this should continue to come down just based on what people are seeing on the market, right? So it should continue to help US CPI to improve. As far as the UK is concerned, continue to decline here, which is good for them, still well above the 2% target. And like we've discussed in previous videos, globally, things are way worse than the United States. As much as everyone likes to think in the US things are awful, if we widen our scope a little bit, we can see things are much worse in the Eurozone, South America. I just saw Argentina reporting 143% inflation. Now, that isn't any excuse for the United States, but from a relative value perspective, mainly on the DXY is where that's super important. Looking at energy and gas prices a little bit, also an important component of inflation of CPI. In the United States, gas prices continue to come down, even though there's still quite a bit of a red on this chart. You know, California is still above 5. Texas, I think the lowest at 280 there. And you can kind of carve out your own little mental model for continental divide, South, Northeast, Midwest, of what those average gas prices are. And if we look at a year over year kind of seasonally adjusted number, you can see we are below 2022 and just kind of in line with 2021. So that's certainly going to help CPI continue to come down. Another thing that's going to help is oil prices, which have collapsed 20% since the top there. TA trend-wise still look bearish. This may, retrace to 80 and then get denied again. It's good that this remains range-bound. We do not want to see runaway oil prices. OPEC can cut, the global economy can turn down, price can go all over the place here, but ultimately we do not want oil above 90. If you want to get political, if you want to refill the SPR, we want anything below 70. If you don't want Biden to get reelected, you want oil at 100. You want gas prices at multi-year highs, right? That certainly won't help approval ratings, which for Biden are already probably at relative all-time lows for anybody who gets reelected. I think I saw 37, which is abysmal as far as a percentage for approval rating. So as we enter election season, that's something important to keep in mind as well. Looking at GDP, it's spiked up a little bit. Again, this is a Fed estimate, just above 2%. There was a lot of hubbub around, oh my God, the Fed GDP now dropped from 2.2 to 1.3. And, no one's talking about this. No one's talking about Fed now GDP rising. So you always got to be careful. People tell you what they want to tell you. The macro doomers will tweet out what they want to tweet data-wise. I'm sure when this drops again, we'll see another tweet from Doomer Hedge about how GDP is going to zero. We get it. But for now, these are the estimates. Agree or disagree with the data. It is what it is. And again, if we compare globally how the other G7, G6, whatever this is, came out of COVID, we have definitely done the best on a real GDP basis. And anytime I look at any of this data for health of economies, Germany is always at the bottom. Based on GDP, the US continues to fare far better than anyone around the world. Now, if we're looking for things to be concerned about on the recession front, this is one such indicator from Jeff at Refinitiv. Leading economic indicators falling. I'll talk about UMich customer sentiment in a second, but doesn't exactly bode well for a soft landing. Some people arguing that a soft landing is just not possible. It's either no landing or hard landing. There isn't anything in between. And we are seeing weak demand. We're seeing weak hiring for seasonal workers, which I'll look at in a second. We're seeing credit cards balloon. So it does feel like the consumer is weakening. The average American is weakening here throughout Q4 into the holiday season. Reverse repo, which is a pile of inert cash that's collecting short-term yield, has moved out of the reverse repo into short-term treasuries to the tune of over $1 trillion here in the past 6 months. This represents a pile of cash that, instead of coming out of risk to pay for debt, US denominated debt or US issued debt, it's coming out of this pile. So the concern for many, including myself, is when reverse repo runs out and the US is still issuing debt, who's going to buy it? What are rates going to be? What does that look like? You'd assume that if the debt issuance continues at the current clip and reverse repo is gone, yields will continue to creep up, prices will go down, and that includes risk. Risk will probably get hit. So it will be interesting if the Fed starts to ease once reverse repo runs out. That'll help the debt issuance sort of, but it's something to watch because our debt payments have passed 1 trillion. So this is, I think, the biggest budget line item that we've got. And it's only going to get bigger. It's only going to keep increasing. So look, this is why we Bitcoin. It's just math. We don't have to have this, enemy at the gate style doomer metal folks where they talk about everything exploding and things heading to a recession. And if you want some more color on treasury auctions or bond market, James Lavish, definitely the go-to individual. He did a great thread, puts out a great newsletter every week on a variety of topics there. Yield curve still inverted. It started to uninvert with a bear steepener, meaning the long end was catching up to the short end. Still inverted, right? We typically see recessions after the uninversion. So it will be interesting how long this can remain uninverted. And if we actually do hit a recession when this uninverts, and what does that look like relative to rates? What does that look like relative to election season? What does that look like relative to halving for Bitcoin? It's going to be a very interesting 2024 as everything is sort of aligning once again. If you look at TLT real quick, it does still have arguably an inverted head and shoulders fractal. If it can get into the daily cloud, I like an edge to edge move there from, let's say, 89 to 93, something like that. I think fundamentally, TLT is in trouble with debt issuance. I do think this eventually does go lower, but it could easily retrace to 93. Everybody's saying, I told you so. And then, the RRP runs out and this thing goes less than 80, like 78, right? Something like that. We'll see. But it does look like a temporary bottom is in on TLT. Let's talk about employment real quick. This is a super interesting headline and data point, just, anecdotal type stuff, which to me doesn't sound like hiring expectations are ramping up. This is a headline that tells me various companies are looking to continue to cut people. It's really hard to gauge because all we're fed every day on social media from all of the accounts is really bolding and italicizing all of the various layoffs or firings. So I know we all see that, but to me, this is maybe more important that, look, generally, we're looking to let go of some people, And if you look at this temporary services category relative to recessions, it is continuing to decline. If we look at retail hiring in a holiday season, that's declined year over year, arguably. If we look at some more anecdotal stuff with FedEx, which is arguably, as I keep saying, arguably a super important shipping slice of the economy, telling pilots, go work somewhere else because we don't have work for you. That's certainly pointing to slowing down of things. If we look at the trucking sector, that's certainly pointing to further slowing. So it certainly seems to me that jobs are quickly slowing down here into the holiday season. And there's been a lot of talk too. Why does the average US consumer feel like things are terrible right now? Well, we can look at wages relative to inflation. My argument has always been, look, Trump caused a lot of this, right? Trump gets off the hook for putting the economy in lockdown. And you can argue it was Fauci or whoever else, but it's interesting how he just gets this free pass. He was the president when this happened. He was the president when we gave stimmies to people. Yes, Biden continued to give stimmies to people, but we can't just give Trump a free pass here. And don't get me started on PPP loans. In any event, wages are just now catching up to inflation. And so there's a lot of catch up still to be had relative to what people have been paying. And you can look at food prices. The average food prices at home relative to earnings have lagged since COVID and really since before 2018. And that certainly won't make people happy as they grocery shop once a week, twice a month, whatever it is. Everybody knows for the most part what these prices have been, and the trend has been rising. And that's the same for housing relative to average earnings. So the consumer is continuing to get squeezed on average. Yes, there's a rich-poor divide. Yes, the rich are doing fine. They'll always do fine. But an increasing number of people are likely feeling the squeeze. And we can see that when we look at average credit card balances, which are at a decade high. Delinquency is rising, right? There's always doomer narratives and doomer data to seek out. It's always going to be there. Like this headline, credit card debt exceeding $1 trillion, which you really need to curate a little bit. You got to see, who has all that debt? Do the high income households have that debt? Do the lower credit score individuals have that debt? Are they paying it off month over month? Like most of the higher earners get some sort of incentive or reward for using the card and then paying it off. This doesn't look like debt that's being paid off necessarily, but who's holding on to this? And even Callie makes a point here where as a percentage of total deposits, it's low relative to 2003, right? Down 50%. But the question is, again, who has this? The people with the money probably don't have massive credit card debt, right? So there is a bit of a mismatch here between who's saddled with all this debt and who has money in the bank. So even this, is optimistic, but it doesn't quite tell the whole story either. And even in this country, we have a very wide range of average credit card scores per state. So it's hard to even paint the country with a broad brush as far as who's got the worst debt, in each state, or which consumer is suffering the most. But certainly the South relative to the North has on average a lower credit score. So I would assume on average they would have higher credit card balances, higher delinquencies, that sort of thing. Another interesting credit data point I came across this week was the mortgage originations by credit score, as far as who's still getting a mortgage, right? Again, the high credit score people, they'll be fine. And this also illustrates pre-2008, the number of subprime mortgage originations, especially relative to now. You can also see when rates were 2-3% or less, right? When on the mortgage side, when these high credit score individuals were going hog wild in the housing side of things. So again, look, the rich people, they're going to be fine. But you really have to curate and divide and understand what these slices of data look like. Card spending has continued to decline, which honestly makes sense relative to where rates are. 25%. I don't know what the average credit card is today, but it was close to 25%. And that's going to change based on your credit score, right? So it does look like the consumer is increasingly feeling the squeeze. And then we've got delinquencies here. These are serious delinquencies, 90 days late. And unsurprisingly, credit cards, the highest slice here. Student loans, the lowest. Also, unsurprisingly, we haven't seen student loans be active long enough. I don't think we're actually going to see that reported on credit until October next year. Auto loans also slowly starting to tick up here. But if we look at new delinquencies, mortgages, autos, credit cards, all continuing to rise, and relative to recessions, again, not crazy, not unexpected. So that leads us to the consumer sentiment data. If you're curious on what the questions are, this is what the actual survey looks like. I'll put this in the comments, but it's basically like, how's your household doing? Do you feel like your job's going well? Do you feel like you're being paid enough, et cetera, et cetera? So they tally all this stuff up. It spits out a number. We have data going back to 1980, 1978, whatever this is. And again, we can line that up with unemployment. We can line that up with inflation. And it is a bit of a leading indicator relative to unemployment. If the blue line here, if consumer sentiment starts to decline, we typically see rising unemployment followed shortly thereafter. Now, since COVID, consumer sentiment has remained at historic lows, likely because inflation is at multi-decade highs, right? And continues to hold at multi-decade highs. So most people are certainly feeling the squeeze, no matter how good some of the numbers might look relative to where they looked a year ago. And you, of course, have great headlines like this, where we're getting these hardship withdrawals, I think they're called, where people are feeling the need to take money out of their 401k. Never a good sign. I don't have multi-year data or anything for this, but it doesn't sound like people are doing so great on average. I also saw a Google Trends graph for HELOC loans, home equity loans, and that's an all-time high. That's a multi-decade all-time high. So lots of people searching for ways to get cash to pay bills, that sort of thing. Generally just strapped for cash. All right, let's round this out with some charts. There's still this beating drum that the US is not where to be right now, and everything else is undervalued. The US is overvalued. It's a bubble. Look, I'm not going to disagree, but look at the economic data in all these other countries. I think we're assuming that all the other countries are going to somehow overperform, which I don't see based on the numbers, but hey, that's what people are beating that drum. Japan, Europe, data's the data. I get it, but I just don't personally see that. And another thing relative to liquidity, stripping out the PBOC, Fed, ECB, BOJ, this isn't always a one-to-one, hasn't always been a one-to-one correlation, but it is unusual that major central bank liquidity has continued to decline, with the S&P continuing to turn up again for the second time, right? We had the AI miracle, or whatever you want to call it. And now it certainly looks like we're ready for all-time highs again. It's party time, baby. As we'll see on most of these charts, they look ready for all-time highs. And let's start with the DXY, which for risk, for stocks, for crypto, we do want to see the DXY calm down, flat, bearish. That's what we want to see. It does look like we're headed in that direction based on the daily cloud. I'm not going to rule out a move to 111, but this would be max pain for crypto, max pain for everybody globally if DXY continues to strengthen, which it may down the road, as we can afford to stay hawkish for longer, whereas these other central banks' economies are hitting recessionary behaviors right now and are having to say, yes, we're going to cut rather soon or already cutting. I think Australia was the last one that raised, but I think collectively it's harder to interpret that, and I'd rather just look at DXY. But in any event, it does look like DXY is calming down. And we have the S&P, which continues to turn up. You can point to any other data point, PE, PS ratio, forward earnings. I don't care. Will that data provide a headwind? Will that data make it difficult for this chart to actually play out? Sure. But, it looked pretty terrible in pre-2023 as well. Now, I don't think we're going to get a second AI miracle, but chart's the chart. We're above the daily cloud. We retested the 200-day moving average. And this is setting up for a cup and handle breakout. Looks phenomenal. We don't have a bullish TK cross yet. We don't have a bullish cloud. Ideally, you'd see some sort of V-shaped recovery and or just kind of a sideways move. below 4,600, but above 4,600, and it's party time. And we'll see how high we can run this puppy. Massive bonus if we get some sort of Fed intervention. And I do think the market wants higher for longer. It doesn't know that it does, but it does, because the moment the Fed cuts is the moment that we see weaknesses or things blowing up somewhere. And the Qs, the tech stuff, looks even better. Very much looks ready to retest recent local highs there. And if we measure this out as a cup and handle, which most people have at this point, it certainly looks great. We get above 390, 400. Yeah, let's see how high we can run this, right? And this may coincide with a pre-halving Bitcoin rally too. It would be extremely unusual to see mega upside still relative to pre-halving, but not impossible. Certainly where we sit on the legacy side, which looks pretty bullish. And you've got gold, which still flat. I don't know why people are still paying attention to this. Honestly, it can't hold above 2,000. It's allergic to anything above 2,000. Once it can get a monthly close above 2,000, then we can talk. You can point at central bank gold numbers. I don't care. Okay. All I care about is the price. You can say the fundamentals point to gold moving higher. Sure. Love it. But until it's above 2,000, I don't really care. Now for the Mag 7, Apple regathering strength looks great. It's not unusual that all these charts look great because the Qs look great. The index looks great. Microsoft all-time high, certainly the strongest of the group, the most likely to continue running probably. It's certainly overbought based on daily cloud metrics here, but it is definitely the most bullish of the group. NVIDIA also canceling out this head and shoulders, and the upside measures to remaining in the broadening wedge. So we'll see what actually happens here, if this can get to 600, if this can get to 580. But look, it's above the cloud. It's got a bullish TK cross coming, bullish cloud. You can't argue that on technicals. You can say, again, it's worth this. It's way above that. I don't care. Let's look at the chart. What does it tell you? It says continuation in the moment. Google's still trying to remuster strength here, but certainly another cup and handle candidate, anything above 140. And it's certainly good to go for a run. Meta also looks particularly strong, reconsolidating at the highs here. From a cup and handle perspective, this is what you want to see on the bullish side. You don't actually want to see a dip to the 50% retracement. You want to see basically what the gold cup and handle is doing, where it's just holding a range. So this also looks very good for continuation. Amazon, I think, is more of an inverted head and shoulders. Still looks great for continuation. It's above the weekly cloud. Less of an upside potential based on percentages, but the chart pattern is just as strong as Microsoft. And then there's Tesla, which lower time frames does have probably some sort of messy inverted head and shoulders there. But I just think this is a massive avoid as a company. It's just not for me. Much rather trade the previous 6 than think Tesla's magically going to break out to 300 plus. But hey, it could. Look, it could. Not going to deny that. Probabilities just aren't favorable at the moment. So lots of data today, lots of stuff going on. Like, dislike, comment, share, subscribe, and happy trading.